Key principles of economics. There are 5 major principles in economics, and to start with, we're going to talk about the principle of opportunity cost. The opportunity cost is something that you sacrifice to get something else. Think of it as the value of your best alternative. Consider an example of attending college. First of all, there's an explicit cost or accounting cost of the money that you spend on books and tuition, let's say $40,000. However, in economics, we also look at the implicit cost, and this is the cost of your time. Let's say 2 years that you're attending college at $15,000 per year, that you could have had a job that pays you that much, will come up to $30,000. So overall, the economic cost of attending college is $70,000, not $40,000, as you originally might have guessed if you looked at just the accounting cost. So in economics, it's also very important to think about the foregone alternatives that are not available to you because you decided to produce something or undertake a certain activity. What does it translate into the economy as a whole? Production possibilities curve represent all the possible combination of goods that could be produced in an economy, provided that those resources are used efficiently. So in the simplest case, let's say we just have 2 goods, steel and wheat. And the production possibilities frontier will represent all the possible combinations that you would have if you utilize your resources efficiently, how much you can produce, say, per year. The combinations within the production possibilities frontier are not efficient combinations because you can actually do better by increasing one activity or another. On the other hand, the points outside of production possibilities curve are not available to you just because you don't have enough resources. However, if you add more resources, your production possibilities frontier will shift out, and now the new combinations of goods becoming available to you. So production possibilities frontier essentially shows you the trade-offs. If you want to increase production of one good, you could actually have to sacrifice the production of another. If you want to produce more steel, you have to decrease the production of wheat. Marginal principle. In economics, we think about decisions that we make on margin. So what we want to do is to see what's the best place for us to be, what's the best level of activity, what's the profit maximizing output. So to look at marginal benefits and the marginal cost would allow us to pinpoint that best location. Marginal benefit is the additional benefit that you get from a small increase in some activity. Marginal cost is the cost associated with this small increase in an activity. In this example, we'll look at the marginal principle and movie sequels. So if you have a successful movie, sometimes you would want to produce an additional installment of it. So as long as the marginal benefit exceeds the marginal cost, you should go ahead and move on. So there's a second installment and maybe third. However, if your marginal cost start exceeding your marginal benefit, it's probably not a good idea to continue doing so. So what's the best point for us to be? That's the point where the marginal cost and marginal benefit actually meet. We will increase the level of activity as long as marginal benefit exceeds marginal cost, and we will scale back if marginal cost exceeds marginal benefit. So the best place for us to be is where they actually equal. Another important principle of economics is the principle of voluntary exchange. It is actually possible to make both parties better off through voluntarily exchanging goods or services. For example, think of you buying a car. You are better off because you're willing to pay that price for that vehicle, and you actually voluntarily purchase it and now are able to enjoy it. On the other hand, the salesperson who sold you the car is actually also better off because he was able to sell you the car at a price that was acceptable to him, and therefore he's enjoying his profit. So he was valuing the car less for what he sold it for, and you obviously was valuing it higher than what you paid for it. So it is possible in economics to make both parties better off for voluntary exchange. It all depends on the preferences. Principle of diminishing returns. We all know that as we increase one of the inputs, your total output also going to increase. So if you have several inputs and one of them is fixed, increasing the other will increase production. But at some point, those increases will come at a smaller rate or diminishing rate. That point is known as a point of diminishing returns. Finally, the real nominal principle. What matters to people is actually real value of money or income or its purchasing power, not the face value. It doesn't matter how many zeros the banknotes in your pocket have. It's actually important what you can buy with this money. So nominal value is the face value of the note, the real value, what could be purchased with it. In economics, it is emphasized that the nominal value of the money is not as important as their real purchasing power.